Global shifts, local impacts. We connect the dots so you don't have to. From the BizNews studios, welcome to BizNews Daybreak. I'm Alec Hogg. Here is the context you need to win the day. Thanks to the team for holding the fort while I had a lovely extended long weekend. But that means you're going to get a bumper episode this morning where we'll be asking questions about the gold market being rigged, whether the AI bubble is bursting, and if the bots are coming for the music industry, and a lot more in this morning's episode. But first, here's the freshest overnight news from our partners at Bloomberg. There's more fallout from the Epstein files. That's front and center.
Latest fallout from the DOJ's release of the Epstein files. Commerce Secretary Howard Lutnick has come under fire for his appearance in the files. Lutnick said he did not visit Epstein's private island in 2012 after Epstein was convicted as a sex offender. Here's an exchange between Maryland Senator Chris Van Hollen and Lutnick.
Did you, in fact, make the visit to Jeffrey Epstein's private island?
I did have lunch with him as I was on a boat going across on a family vacation. My wife was with me, as were my 4 children and nannies. I had another couple they were there as well with their children, and we had lunch on the island.
Now, Lutnick is facing calls to resign over his relationship with Epstein since the files show the relationship was more extensive than Lutnick previously revealed. The White House said today that President Trump has no plans to remove Lutnick from his post. The brother of Elon Musk, Kimball, was connected with at least 2 women through Jeffrey Epstein. Emails released by the Department of Justice show an easy rapport between Kimball Musk and Epstein as they discussed party plans, relationships, and whether Musk would be able to visit Epstein's island. In a statement, Kimball Musk said his only meeting with Epstein was in his New York office during the day. Paramount Skydance has enhanced its hostile takeover offer for Warner Brothers Discovery. In a statement, Paramount said it will cover the termination fee that Warner will have to pay Netflix if it were to end that already agreed upon deal. And Paramount will also backstop a Warner Brothers debt financing.
The gold price edged up to $5,100 overnight. That helped the rand, which starts the day a little firmer at 15 Rand 88 to the US dollar. But after all the recent volatility, there's some serious voices asking, is the gold market rigged? The US Treasury Secretary Scott Bessent seems to think so, blaming recent volatility on speculative trading coming out of China. Bessent is their version of Enoch Godongwana, so a heavy hitter, the man who looks after the books in the United States, if you like. There's more to the story than just market manipulation, though. Amy Gower, Morgan Stanley's lead metals strategist, joined the team at Bloomberg Surveillance to discuss whether gold is still a safe haven or just another speculative asset that's caught in the crossfire. We start with Bessent's view.
The gold move, things have gotten a little unruly in China. They're having to tighten margin requirements. So, the gold looks to me kind of like a classical speculative blowout.
So it seemed like Scott Bessent was talking about the hat. He's currently blaming this one trader who had an incredible slew of losses in China and then fled the country. I mean, it just raises the question of how financialized some of these metals markets have gotten. The idea that suddenly people are turning to precious metals as an alternative to things like treasuries, which are a very deep liquid market. How comfortable is the gold market, is the silver market with this moniker to be treated as an alternative to full faith and credit in the United States government?
So I think gold has kind of always had this role as a safe haven traditionally. So you have had, yes, financial flows, but also real physical buying from central banks, from ETFs, and kind of we're used to this sort of flow in gold. I think for silver, because it's also got that industrial metal hat, probably this is where it's a little more difficult because there are real end users who also need silver. So when people are suddenly trying to buy quite large volumes for financial reasons, and then you still have the physical buyers. That's where things get a little tense. So gold, I would say, should be okay with this. Silver, obviously a lot of volatility as we're seeing.
Then you overlay the fundamentals, which is that every country in the world is trying to build up its strategic reserves of some metals, as well as try to build out their infrastructure. We heard about the vault from President Trump, that he wants to stockpile certain metals. Do you have a sense of how much that could really skew valuations? Is that already priced in?
Yeah, so I think the stockpiling theme is super interesting. So we have, as you say, Project Vault launched in the US, which is looking for any critical minerals. Now, the US critical minerals list is about 60 different metals. Some of these are very, very small markets. Some of these are much bigger. And so I think we need to see what ultimately is going to be top priority in terms of stockpiling. I can think, it's probably, it could be any of those metals, but the larger ones could be more easily able to absorb that stockpiling. You could say for copper, actually, already, the US has already built quite a large stockpile. Last year, the US imported probably 2/3 again what it would normally need, and most of that is just sat in the warehouse system. So actually, you could say the US may have an incentive to try and keep that in the country rather than letting that be exported.
I was going to ask you about copper too, because really this matters with demand in China. How weak is the demand, is soft the demand right now for copper in China?
Yeah, I think it's remarkable how strong copper has been, considering what we're seeing in the Chinese demand. And this is not a new story. This is something that started back in September, October time. Q4, we saw Chinese apparent consumption down around 12% year on year. So that really weighing on the sort of total full year 2025 demand number. We're going into Lunar New Year, which is where activity typically slows down. So often you see the semi-fabricators slowing down their activity. But yet copper has proved remarkably resilient, which I think tells you there's broader macro factors at play. There's this theme around the AI trade, stockpiling, scarcity, supply chains, and then also these macro overlays of rate cuts still coming through, demand for real assets from investors.
On to our next question now. Is the AI bubble bursting? The bond market, which is where the grown-ups live, says absolutely not. Alphabet just raised $32 billion in less than 24 hours, including a bond that won't mature for a century. Robert Schiffman from Bloomberg Intelligence explains why creditors view this debt as a trophy rather than a risk, and why he thinks that bubble fears are so 2025.
In less than 24 hours, they've raised $32 billion, basically, on the debt markets. Let's just focus in on what that 100-year debt signals about the confidence people have in this company.
Well, I think what the bond market is telling us is that AI bubble talks are so 2025. That the concerns that, at least from the creditor's perspective, is not anything near what it is from an equity standpoint. The reality, though, is what is the benefit of a 100-year bond? To me, it's just a trophy. It's going to be put on the shelf of pension funds and insurance companies. They're going to hold it to maturity. It sort of becomes monopoly money, the type of spending that we're seeing. I mean, we're now projecting over $4 trillion of cumulative hyperscaler spend through 2030. You can afford a lot of that from operating cash flow. However, how do you supplement it? You supplement it with really cheap bonds. And the way that you can do that is you start off with balance sheets that are in phenomenal shape. If you look at Alphabet's AA+ credit rating, S&P came out yesterday and said, in order to breach their downgrade trigger, they would have to issue more than $180 billion of incremental net debt. So what I would argue is, hey, if they wanted to be a BBB name, would they have to issue $1 trillion of bonds? There is so much capacity. Why not take the money down, borrow long-dated paper at 5.5%, 5.7%, put it to work today, and grow your future cash flows for another decade, if not 100 years?
Third of the big questions that we posed in the introduction is AI coming for the music industry? Well, Spotify investors were worried, but the company's latest earnings report last night says not yet. Shares surged by 15% after Spotify posted blowout user numbers, proving that human listeners are still sticking to their platform. Here's Bloomberg's Ashley Carman on why the market was wrong to panic and why Spotify's ad revenue is the only sour note in an otherwise perfect quarter. Spotify is one of a number of stocks that we used to hold in the BizNews portfolio that get focused this morning. We do know that not everybody follows the model portfolio directly. Sometimes they buy the shares and hold on to them. So I think the tribe might enjoy the coverage that we have on some of the news-related stocks of the moment, starting with Spotify.
Let's check in on Spotify shares having a strong day, up 15%, at one point having their biggest move on record after the company reported, record user growth in its fiscal fourth quarter and $835 million in operating income. Let's turn to Bloomberg's Ashley Carman, who broke down the numbers. And look, the mighty have fallen a lot coming into this number, Ashley, so the bounce back is perhaps not surprising when they're able to give some sort of ease to the investor base.
Yeah, and I think that was a lot of what this call was today, is just addressing concerns that AI, specifically AI music startups these are supposed to launch this year. So people are concerned, are people going to start using AI to generate songs and then listen to those songs on other platforms, or are they going to keep coming to Spotify? And today, the co-CEOs were saying, we think they'll keep coming to Spotify.
So the stock at one point was up on track for its biggest jump ever. It's now up 15.5%. I think on track for its biggest jump in 7, almost 8 years. You write about in the report the impact of Wrapped. For those, although I don't imagine there's many that don't know what that is, Ashley, just explain it. But why was that such a big factor?
So Wrapped is their annual interactive viral marketing campaign where people share their music and podcasts that they listen to the most this year. And every year, it is just a moment on the internet. People tend to activate their service to participate in Wrapped, so they always expect to see a boost. But I believe on the call today, they said this was their biggest Wrapped ever, so we can really see the results of that marketing campaign.
But are people advertising more with Spotify? Are they able to drive revenues not just by having more of us tune in and unearth our Spotify account every end of year?
So this is the one part of the earnings today that was a little bit gloomy. The ad-supported revenue actually dropped year over year, and this has been a part of the business that people are really wondering, when are we going to see you start making more money from advertising? Which is also an important question, because when we're talking about them adding users, these are ad-supported users. Subscribers grew as well, but if you're going to keep adding ad-supported users, you also want to see the revenue in that department go up as well.
Now, here's a stock that we haven't invested in, Robinhood, whose shares took a knock in the aftermarket, but the company has got a new trick up its sleeve. Sports betting, disguised as prediction markets, that's what they call it in the United States. We're a little bit more upfront here. It's a controversial pivot from Robinhood, which is a retail operation that offers share trading, very much like our own Easy Equities. And it seems to turn the Robinhood app into a casino, much like what we saw during COVID. It's a trend that local investors in Purple Group, which owns 70% of Easy Equities, will be watching rather closely. Bloomberg's Robin Wigglesworth joins the team to discuss if this is a masterstroke or a sign of desperation.
Expectations going into this were relatively high, even though the shares have been under pressure of late, but down 8% in the after hours. What's your immediate reaction?
Yeah, so I think the immediate reaction is that we know that Robinhood is sort of building a franchise in the shadow of Schwab, we'll call it, right? But ultimately today, Robinhood, as we know it, earns about 60% of revenue from transaction-based sources. So crypto trading, options trading, equities trading, all that is incredibly important and part of the lifeblood of the fundamentals for Robinhood, which has been really strong in 2025. In the fourth quarter, activity was pretty strong. It looks like we missed estimates on crypto, which of course is a very big story to start 2026 in terms of the sort of dive that we've seen in prices in that space. And so ultimately, I think the question is, what happens to retail sentiment more broadly as we move forward? We've obviously had pretty steep pockets of unevenness in the markets tied to software, tied to AI scares, et cetera. And when crypto's, 20, 25% of your revenue, and that's, very well off the highs as well, the question is how engaged do the retail traders stay where, 75% of customers are below the age of 40 on Robinhood. The average account balance is $12,000 in those accounts, right? So where do you go from here when some of the things that you were most active in trading in are not going up and to the right?
Well, maybe that's prediction markets.
And that's, something that I'm sure they'll point to on the call today. And, that's a business that frankly didn't exist 12 to 18 months ago. And now it's, somewhere between 5 and 10% of run rate revenue for Robinhood. So they've created that sort of out of thin air. What we do know that when you say prediction markets, 90% of that is actually sports betting.
Yes.
So that's certainly, a question that we have broadly across the industry of should that be on the application where you're, supposed to be investing long term. But ultimately what Robinhood has really done, and the mantra is, giving clients what they want, access to it in a very easy, cheap way to use, and that's what they're doing. So for now, it's there, and that's going to be a tailwind to the extent that it's allowed by regulators to stay there. So we'll have to see how that develops.
Like a soapy breakup scene, selling your car can be an emotional experience.
Just how dramatic was the car selling experience?
Not dramatic at all. I did my research, and WeBuyCars was by far the best price.
Very not dramatic. But I like drama.
I was standing there watching my phone, waiting for the money to get in, and there it was.
Yes. Car, driving.
WeBuyCars, the easiest way to sell your car, by far.
I wouldn't mind a little more drama. Anybody bring me some tears?
Another stock that we eased out of some time back is the Danish drug maker Novo Nordisk, which has had a bruising year with shares down more than 50% in the past 12 months. Now the maker of Ozempic and Wegovy is facing a new battle on its home turf in the United States. The pharma giant is suing telehealth platform Him and Hers, accusing them of selling copycat weight loss drugs. But as the Financial Times' Patrick Temple West explains to the host of the FT News briefing, Sonia Hudson, the legal fight may be a sign of deeper trouble for the Danish drug maker.
On Monday morning, Novo Nordisk sued this company called Hims & Hers, alleging patent infringement. That Hims & Hers is essentially selling copycat, in their words, weight loss drugs in the U.S. here, which violates Novo Nordisk's patents for Ozempic and Wegovy. This has been simmering for a few months. Novo has never loved the fact that Hims is selling these drugs in the U.S., but it didn't really catch fire with the company until last week when Hims & Hers just came out of the blue and said, we're going to offer a weight loss pill that is directly in competition with Novo's brand new weight loss pill.
So Hims' share price fell 16% yesterday. How has the company responded to the lawsuit?
Hims gave us a statement attacking Novo Nordisk, calling it a Danish company, going after Americans who are trying to get weight loss drugs. Hims backed down over the weekend and said it is no longer going to sell the weight loss pill that sparked this whole fight. But the horses are out of the barn at this point, and Novo has taken them to court. So we'll see where this fight goes.
And this lawsuit is coming on the heels of some disappointing earnings results and forecasts from Novo, right?
So both companies are suffering in the past year or so. Novo Nordisk, due to some pricing pressure in the U.S. and significant competition from its top rival in weight loss, Eli Lilly. Last week, it warned that its net sales would fall by as much as 13% this year, which was worse than expected than most analysts and investors were hoping for from the company. Novo's shares are down again and have dropped by more than 50% in the last year.
Wow, that's incredible, especially given that Novo used to be Europe's most valuable company. Why is the company struggling so much?
Part of it is Novo has significant competition from its only other rival in weight loss, Eli Lilly. Eli Lilly just seems to have a better sales apparatus. Novo Nordisk has come under pressure from President Donald Trump. Novo and Lilly did as well. They agreed to pricing deals with Trump late last year that dropped the price of Novo's weight loss drugs in the U.S. The company has been somewhat struggling in other areas. Novo Nordisk, in November of last year, announced that one of its Alzheimer's trials failed to slow progression of the disease. So that has just added pressure on the company, added pain to the company, and really forced it to prioritize the weight loss space to keep its revenues going.
We close today's episode with another stock that was once amongst our favorite, and it certainly is among one of my favorite software operations, and that's Xero. We use Xero all the time at BizNews, like millions of SMEs around the world. Unfortunately, Xero's share price has more than halved since June, dropping from $194 to just $85. We got out a long way above 85, thankfully. And this was amid a wider tech rout and what you might have heard of a SaaS apocalypse, software as a service apocalypse. Facing concerns that AI might disrupt its business model, the CEO of Xero, Sukhinder Singh Cassidy, remains defiant. She told investors that she even tried using Anthropic's Claude to clone her own platform. To get an insight into how dangerous it is, you might recall that a week ago, Friday, Anthropic brought out new tools that put investors into a bit of a panic about pretty much every software company. But Cassidy explains to our partners at Bloomberg why that experiment that she had with Anthropic's Claude proved that Xero's competitive advantage is much safer than the market thinks. Something to ponder.
You know, I think that the market right now is not distinguishing between the many types of software companies and the position they play with their customers. So I do think that the broad sell-off does not really distinguish between the value propositions of different software companies. So for us, I mean, we did an investor briefing on Monday about how excited we are about using AI technology and being the layer that brings that to our customers with a domain-specific use case that can be multiplied, we think, with the use of this technology.
In a presentation to investors, you were cited as saying that you used Anthropic's Claude coding tools to try to clone Xero. Tell us about that. Tell us about investor reaction and what are the questions you are getting from investors?
I use all the tools. I think if you're a CEO in today's age, you know, use the tools, understand the power and the limitations of the tools today and how they're going to get more powerful. So when I used it, it was very easy to build a simple reconciliation. But when I tried to have multiple agents, they prompted me to go build much of the technology Xero has. A good example would be, hey, it's great that you gave me your bank statement, but I need you to be able to plug in multiple bank feeds. Well, of course, that's the data layer I'm talking about at Xero. So I like using these tools because I think our job is to understand the power of this technology and harness it, not be afraid of it. In terms of other questions investors are asking us, look, we have had and continue to enjoy, I think, strong long-term shareholders in Xero. I think when we gave the investor briefing on Monday, I think they were excited to hear us talk about our differentiators and excited to hear us, quite frankly, talk about AI adoption on our own platform. We use multiple LLMs behind Xero's own AI technology. We call it JAX. And we shared with them the early adoption figures on Xero. 300,000 of our customers are already using new Gen AI features we launched within the last year. And of course, over the last 20 years, we've used traditional AI and have well over 2 million customers using traditional AI at Xero. Again, all harnessing the powerful technologies being built.
Well, as promised, a bumper show for you today. And now you have the edge. For the full interviews and the details behind these stories, head over to biznews.com. I'm Alec Hogg. Thanks for starting your morning with us. Now go and seize the day.